Okay, Sherry, now that we've taken care of the car policy and the home policy, it's time to talk about that life policy. Right? So we've been putting that off, but I'm glad that we are going to have that conversation today. Do you have an idea of how much you want covered?
No, I know last time we talked, it was pretty generic, and
Mm-hmm.
I forgot about it already.
Yeah, yeah. Well, and then of course, 2 years, a lot has changed. Therefore, that number is no longer real anyway. So why don't we do a quick assessment? Okay, we already know that currently your mortgage is $600,000, right?
Right.
If you were to pass, do you want to get that paid off so that your husband does not have to worry about it at all, or do you want only a portion of it paid off, or what? What is your thought?
I mean, ideally, I would love for him to live mortgage free so he doesn't have to worry about that over his head all the time.
Okay, and I would imagine the same for you then, if he
Right.
was to pass, right? So I'm gonna do this assessment where you're gonna have to help me with what you think he wants, and then of course you know what you want. And
Okay.
if there's any changes to this, once you speak with him, come back and then we'll make those modifications if need be.
Okay.
Okay? Tell me about your short-term debts. Let's say your credit cards, your auto loans, your medical expenses of any kind that may be outstanding, any school loans, any other debts like that. How much do you have, if any of that?
So for myself, it
Mm-hmm.
would just be the car loan,
Okay.
and that's about 35,000.
Okay.
And my husband, he had to go to extensive schooling
Mm-hmm.
for his job, and he has about, I want to say right now it's about $200,000 for his student loans.
Okay.
But I believe that does get paid off if he does die, right? It doesn't that get forgiven if he dies?
You know, that's a really good question, and it is something you probably want to do research into it. I know some of the debts, when it is occurred before marriage, that it does not carry into the marriage. But there are some debts that it will carry into the marriage altogether. And so you may not be responsible for his debts, but remember, you two now own the same assets together. And so the value of his assets still, and the estate, his estate, all of that is still going to be utilized in terms of calculation to settle any debts that he have. So it's a good question, but I have a feeling that even if you're not directly responsible, you two are going to be sharing a lot of assets together, and that will be taken out of there. So the question would be, do you want, if he was to pass, do you want that all that to be taken care of so you maintain what you have, or do you prefer that it's taken out of the estate?
Got it.
Okay.
Okay.
All right. So it looks to me like he would have a need of about $800,000, where with you, no student loans of any kind. So
No.
we're at $635,000, right?
Right.
Okay. Then what about final expenses? Is there any final expenses that you or want to have paid off? And I'm talking about possibly burial expenses, if you would rather not have that set aside so that you don't have to worry about it at the time if that happened.
For funeral costs,
Mm-hmm.
last I looked up, I think it was about $20,000 for a proper funeral that I would personally want to have.
Okay. Same for,
And I believe same for him as well.
okay. All right. And then once we get that taken care of, what about your son's education? Do you want to set up some educational fund just in case something happens to you tomorrow?
Yeah, definitely for college expenses, I would. Right now, he's so young, we haven't really thought much about it.
Mm-hmm. So how much do you think would be comfortable for you?
How much is school nowadays for college?
Well, it depends on what kind of school you want him to go to,
So let's
public
say,
or private school, and what kind of schooling.
right. No, I understand that. So let's say right now in California, if he would just go to a UC,
Mm-hmm.
how much do you think it costs right now?
Well, my daughter is in a UC system right now, and a year it varies anywhere between $35,000 to $40,000, and that's actually is a really good price because private school can double that as well, and that does include room and board. So is that a good calculation you want to go by?
Yeah, let's just go by that. So 35 times 4, it's about 140,000.
Mm-hmm. Yep. And then the $655,000 yours as well. So that's $795,000. So, and that is a 4-year college then that you're intending to leave for him, right?
Correct.
Okay. Okay, and then from that, are there any other needs that you can think of? Many people may sometime want to leave something for charity, sometimes they want to leave something for their parents, other loved ones in their lives. Do you have any needs like that?
I think we have savings accounts set up for them, so we're good for now.
Okay, well, so is that part of the savings that we talked about earlier
Yes.
in those accounts? So let's kind of leave that aside for now first, because right now we just want to talk about what is needed, right? So what is that amount? Who are you leaving that money to?
I want to leave some for my parents.
Okay, how much is it that you want to leave?
About 25,000 should suffice for now.
Okay, so that totals $820,000. Okay, and then your husband, on the other hand, because of his debt, then he has $200,000 more than you. So your need, should he pass, is $1,020,000. His need is $820,000. That makes sense?
Yes.
Okay. Now there's one more thing that we needed to take into account. If we take care of all of that already, there's still an income replacement need possibly. What I mean is that if he was to pass, with us paying off the final expense, all your short-term debt, paying off the mortgage, leaving some education money, and some money for your parents as well, do you still need to have some income coming from him to help you maintain your standard of living?
Well, so he's the primary breadwinner, so I think with his income by himself, if I were to pass, I don't think he would need anything from me.
Okay.
And if it were vice versa, yes, I would need some of his income to maintain that same standard of living.
How much would that be that you think you would need after everything is paid off?
So after everything is paid off, I would just say about $6,000 a month additional.
And is it something that you want to maintain for the rest of your life? Is it something you only need for a certain amount of time?
Well, so I feel I would only need it until my son is grown. So pretty much until only 18 years old.
18 years old. So right now we're talking about 18 years still, right?
Right.
Okay. So then we are talking about $1.2,096,000. So it's about 1.3.
Okay.
Okay. Therefore, you would need a life policy on him for $2,320,000 to meet this need. Now that has not taken into account of what you currently have in terms of your assets and that you have been saving. So that was $1,045,000. If one of you were to pass, do you want that savings to be untouched, or do you want to take that into account to meet this need?
I would prefer that we take it out of our savings.
Okay, so if we look at that, then you would have a need on your husband of $1,275,000 to make sure that it meets your need in terms of paying for everything and maintain the standard of living.
Okay.
Okay. On the other hand, with your husband, because you have over $1 million in current asset already, and his need is $820,000 to cover for you, it looks like the current saving is sufficient, and he really does not need to place life insurance on you.
Okay.
Okay. Now that being said, I'm going to discuss a few options with you though, and then I'll work up the number. Even though there's no need for you to have life insurance, you guys are also accumulating quite a lot of asset, and I would imagine that as you get older and both of you continue to gain more income and you are able to save quite a bit, we would move from covered needs to legacy, meaning that whatever you have at some point, everything paid off, you're going to have all this money, and at that point you may end up wanting to leave all of that to your family. So then as you accumulate asset and you leave more to your family, you will be facing what's called estate planning situation where you may have to pay taxes on whatever you pass on to your heirs. So even though there's no need for life insurance on you, there may be a future need of life insurance to make sure that taxes are paid and that your family gets to maintain everything you work hard for in home. So, and you know already that we've discussed is having life insurance early, you keep your premium lower, then you will, depending on the policy that you pick, you can actually also have it paid off. So would it be something that you want to look at in terms of having life insurance to protect your future assets and setting up kind of a tax strategy for your family instead?
Yeah, that's actually definitely something that we've been looking into. You know, we pay so much in taxes recently that anything that we have, I mean, any strategies that you have to kind of minimize that would help a lot.
Absolutely. Now tell me, do you have a trust already set
No,
up?
we don't have that set up.
Okay. That is also another important thing that we do need to talk about because of all the assets you have. If you don't have a trust in place, then the court will decide that for you. So I do want you to also get in touch with a trust attorney to have all of that set up. And in that conversation, we're going to be talking about a life ILIT as well. And that's how we're going to set up life insurance as a way to cover for any potential tax expenses that can occur for you in the future.
Okay.
Perfect. Then let me work up some numbers and then we will see if that fits your budget.
All right.
So, Sherry, there are 3 options in here, and I wanted to go through all of them because life insurance basically have 3 products: term, whole life, and universal life. I wanted to show you all 3 of them because I want you to understand the choices that you have and then decide what's best for your family. Also, I want to make sure that you understand that so that once we have this set up, if you ever meet any insurance agent who propose something, then you would be able to know what they are comparing against the proposal that we currently have for you as well. Okay?
Okay.
All right. So let's look first at a term policy. Term policy is the most economical type of policy. You pay the least and you have very high coverage. So for example, as you can see, the policy on your husband here is $1,275,000, and the cost for that is only $300 a month. Now this is a 20-year term, and what it does is that this premium is going to be fixed for you for 20 years. But you can see here that after 20 years, that premium is going to be a lot. And so many people who gets into a term policy, they are intending to have this policy short term, sometime to cover the mortgage, cover kids' education, maybe a business partnership, but then they don't have intention of keeping it long term. Or they are on a budget and they cannot afford it right now, but they do have intention of converting into one of the other permanent plan that I'm going to show you. Okay, with our term product, we do offer a waiver of premium of disability. What that means is that if you ever become disabled, or in this case your husband become disabled, we will continue to pay into the policy for you until he can come back to work again. And if that never happens, at the age of 65, it gets converted into a whole life permanent plan, and then he would have that plan until 121 years old. Okay?
Okay.
Any questions there?
No, that one seems pretty straightforward.
Okay. The next plan that we have right here, this is a whole life policy. As you can see, for the same coverage amount, it's a lot more. We're talking about $2,000 a month, okay? But I don't want you to think of this as a cost. I want you to think of this as putting money in to protect your family, because where do you go to put in $2,000 a month and have $1,275,000 of coverage, okay? Now, outside of that though, if you take a look, the premium remain exactly the same over time, and that's what makes this policy super attractive, is that the premium will never increase on you. Then on top of that, you can see that some of the money is actually put into a cash value account, and this cash value basically is an accumulation that the insurance carrier put together for you, and you can see with time it slowly increases, and you can see here 20 years later it breaks even. Now once it breaks even, you can stop paying into the plan. And when you stop paying into the plan, then the interest that it continued to earn will pay for the death benefit for the duration of the life policy. Of course, that is based on the current rate of return. We do have a guarantee of 2%, but this rate right here that I'm illustrating is not a guarantee, and it's 3.5%. Should that rate drop though, the time that you pay off could take longer, or sometimes you can't stop paying it off. On the other hand, if the rate of return does increase, you can actually stop paying into the plan earlier as well. Okay?
Okay.
Does that make sense to you?
Yeah, so you mentioned that I can stop paying at any time. Do you know when?
Well, so like I said, when it right about here where you see 20 years later, that's about when it breaks even. Of course, we don't commit to that number, and when you get closer to that date, we do what's called a illustration of premium offset. And then once we look at that number, we can confirm more to the exact date of when you could possibly get it paid off.
Okay.
Okay. Now, saying that, we do have, if you really like this and you don't like that variation, I do have a limited pay policy that is guaranteed that after 20 years, it is paid off. Now, taking a look at that, and I have it ready for you here, it's going to cost $3,000 for that guarantee. And some people still really enjoy it, because if you have money sitting around in your savings account earning less than 1%, this is really a good option. As far as putting into this, it is still accessible in the cash value and allowing you to also protect your family as well.
Okay, I see.
Okay. The other thing I want to mention is you see here, and in the first few years, the money you put in and the money you take out, it's always less, right? However, you can see this break-even point. At this point, when it break even, you can start seeing the gain. Now, the gain in your cash value, that is growing tax deferred. You're not charged taxes on that. When you go to take it out, depending on how you take it out, you actually may be able to utilize this money income tax free as well. So that's a really attractive feature of a whole life or the other permanent product as well.
Okay.
Okay. Any questions for me there?
None so far.
All right. One thing I do want to mention, with a whole life policy, once you commit into this plan, you are committed until the premium offset. And so if it is something that you can't commit to, then I have the second plan, which is called Flexible Life, that you may want to consider. Okay. And Flexible Life is similar to the whole life product in the sense that it has cash value as well. The death benefit is exactly as it is, and you can see in the whole life policy, I was illustrating it at what's called paid up addition. And what that means is, as you have your cash value, it ends up getting added over here to your death benefit. But on their universal life policy, that is not the case. This option, it is just basically death benefit only, and then any extra money that you are earning, it goes into your cash value, which is again accessible. Okay, I want you to compare a couple of things for me. Take a look at this cash value here in a flexible life policy. In the flexible life policy, you can see that you have a lot more cash value in the earlier years, where in the whole life policy, that's not the case. That's why it's called flexible, because you have the opportunity to pull out your money a lot earlier. But also because of that, the rate of return is a little bit less. The guarantee rate is only 1.5% and it's paying 2.5%, because we are not able to invest that long term. Therefore, your rate of return is a little bit lower as well. However, it does allow a lot of flexibility in terms of accessing your money early. Besides that, you can see if you continue to pay this premium exactly the way it is, it is also very solid, same premium through the years, right? With Flexible Life, though, it does allow you to choose to pay into it some more in the future. It allows you to also choose to increase your death benefit as long as you qualify through underwriting. Or if things are tight, after the first 3 years, you can actually stop paying into the plan. And then the policy, because it has higher cash value, it can sustain it for a long period of time. Of course, if you wanted to make sure that it's paid off once you stop, then you would have to kind of look at the same thing here, is that it looks like in this case, it will be 25 years before the break-even point, and that's about when you can kind of stop paying into the plan, and then you should have that death benefit for the duration of the policy. Again, it's not guaranteed. The only policy that have guarantee is the limited pay. This one, it gets affected by the market as well. If market goes up, then the time that you can get it paid off is a little bit shorter. If the market goes down, it will take longer or maybe never at all. Okay.
Okay.
What do you think between these three policies? Which one are you favoring?
Well, I like the universal life because of that flexibility in terms of whether I get when I get to pay and then when it gets paid off. And you also mentioned that I can utilize that money at any time.
Yes, absolutely.
Yeah, so that actually is something that, as my kid grows up and then if he ever decides to buy a new car, then that way I can kind of utilize that money to get a new car.
Absolutely. And a lot of parents do that. Oh, and in fact, since you mentioned your child, I do have the live illustration on your son here, and I ran it at $500,000 because, again, it's not that you need life insurance on him per se, but the earlier you purchase a life product, especially the permanent plan, the lower the premium is going to be, and that's fixed for life. So for his $500,000, as you can see, for your husband, it is $1,800 a month, but for your son, it's only $200 per month for this coverage. So you can see that's a huge difference, right? And then also I did $1 million on you just because of the estate planning that we were talking about. So in the $1 million for you, your premium is only $1,200 on this flexible life as well.
Okay.
So what do you think about all of that?
So I would say right now I have to talk to my husband for his plan, but for myself and my son, for my son, I need to talk to my husband about that as well. But for myself, I would say let's go for the universal life.
Okay.
To get it started.
Perfect. I will get it started. And then, yes, I'm going to go ahead and email all of this illustration over to you. And then I will have some pointers right on here so that it reminds you and it makes it easy for that conversation. And I'd be glad to get onto a Zoom call too. I know he's super busy and can't come in very often, but I will be glad to do a Zoom call with him. And I'm pretty flexible with my time, so I can meet him in the evening or the weekend if it's better for him as well.
Okay.
Okay, perfect. And I just noted here that his birth date is coming up. So let's have that conversation with him before. That way he doesn't turn an age and then the premium goes up on you.
Okay, yeah, definitely.
All right, perfect. Let's get that started.